Now, part of that is achieving a certain amount of literacy in the basics of accounting. And I just took a snapshot of a big company, Adobe, as of earlier this year, on their income statement and their balance sheet, so that you can start to decode some of this standard language. And I highlight a few things there that are really important to understand. Some explicitly mentioned here, and some which are derived from the information on a balance sheet. What you find on or an income statement, what you find on the balance sheet and the income statement are usually highly standardized. In a given industry, everybody will report basically the same line items. There is a lot of sophistication in understanding exactly what's included in each of these things. And often, if you were to listen to the earnings call of a public company, the analysts are probing into certain line items, trying to understand better exactly what's going on under the covers. What was the product breakdown in finer granularity? What was the source of the costs associated with something? What was, for example, you notice that in the quarter ending March of 2024, there was an acquisition termination fee. That's $1 billion that Adobe paid somebody because of an acquisition that failed, that they made an agreement and then they terminated that agreement for some reason. And part of that initial agreement was that there was this divorce settlement agreement, this prenuptial that forced Adobe to pay $1 billion. These are things that people want to know about. So typically people talk about the top line, sort of this total revenue. That is all of the fulfilled obligations for delivery of product and services. And this often comes back into an important subcategory of recurring revenue, particularly in a business where there is software as a service or rental or subscription. There's an assumption that once you have a customer, they will probably go on being a customer. And therefore, the level of annual recurring revenue, where do you have long-term commitments, is a measure of momentum for the business. People care a lot about revenue growth rate. And you might see that companies are valued, both public and private, in the tech space, almost more on their revenue growth rate than on their profitability. Because revenue growth says differentiation. Revenue growth says future profitability. Revenue growth says compelling value proposition in the minds of customers. And so it is a great indicator of where the company will be, what kind of stature it will have a year, 2 years, 5 years from now, if that revenue growth rate can be sustained. So understanding why is it growing? Was there a one-time sale? Did you cut prices in half and you got a sudden burst of growth just because you made the rest of the financial model worse? Or was it because of real adoption, real enthusiasm? Understanding gross profit, gross margin. When we talk about gross profit, that means really the revenue that you got minus the direct cost of supplying that revenue. So that typically does not include what did it take to market the product, what did it take to engineer the product. It was like, what were the materials associated with it? It probably does include the cost of installation. So if you had to send engineers to install and service that product, that's often included. Certainly it includes whatever licenses you paid on an incremental per volume to do that. So if you are passing through some amount of services from other sources, that will often be included there. So, for example, um, if you're running your product on AWS, the the costs you have with AWS probably show up in the cost of revenue and in the gross profit. Then you have operating expenses. And for startups, operating expenses are completely dominate what's going on because you don't have much revenue in the early days. So you don't have much cost of revenue. The gross profit line is usually a really small number. Um, but research and development, sales and marketing, general and administrative are the three broad categories that you're typically tracking. And it's probably the case that R&D dominates that. When you get to a big company with a stable product line like Adobe, they do a lot of sales and marketing. You can see that they don't spend nearly as much on R&D as they spend on sales and marketing. General and administrative typically is a really small number at the beginning. Maybe you have a financial controller. You probably don't have a public company style CFO in the early days because it's not really that necessary because the tracking of those kinds of issues should be a partnership between your controller and your CEO. And you ultimately get to an operating income, which is sort of what did you earn before you think about all the extraordinary things where interest expense or interest income, investment gains. Generally, you shouldn't have much in the way of investment gains. And then you have income before taxes, and then you have provision for taxes. And it's sort of expected that you will be taking a loss in the early days. And you actually are accruing a deductive amount of loss that to a large extent is going to be offsetting your income in future years and reducing your tax burden in future years. So another reason why you want to have good accounting, even before you have to pay taxes, because you're going to have really this bonus that comes from accrued losses. And then there's some pro forma calculation of what was the net income or loss per share. You can see that Adobe went to a pretty significant jump in net income per share. I think really in part because they saw their operating expenses go down because of this one-time acquisition termination fee in a prior period. If you look at balance sheet, that really is telling me, most importantly, how much cash do you have? Cash and short-term investments. When you have a lot of cash, you put a lot of the money into some form of interest-bearing investment, something that's typically extremely low risk. And so you're not getting a lot of interest. You're not speculating. No investor is typically paying you to make speculative investments in junk bonds. But they do expect you to earn something on the cash that you're not going to need in the short term. And so people are typically doing things like putting some of their cash into 6-month bonds and often doing what's called laddering of them. You put, say, a sixth of your investable cash into a 6-month bond this month, and then in 1 month's time, you put in another sixth. And so you're always getting cash coming back out of investments so that you have the liquidity if you need it on a continuous basis, even while getting the interest benefit of having 6-month bonds that you're buying to get interest. So current assets are important because that's really about the money that you have available. Now, noticeably, You have some trade receivables there. That's the money that people owe you that you expect to get. So it's the money you expect to get less what you think is now iffy. You've got a customer who's going out of business. You've got a customer who's said, I'm not going to pay you until you do this thing because we disagree on the contract over what was there. And you may have to make allowance for uncollectible receivables along the way. And then you have other assets. These are things that are awfully hard to turn into cash if you need it. You may have bought equipment. You may have the future use of your property. Yeah, you could sublease in some sense, but it's not very liquid. There's a big category here, which is really a little bit tricky to define, and that's goodwill. And really that represents the gap between what you're valued at. Somebody paid for shares of the company, which set a value at the company, and yet the identifiable assets were far short of that. And so that gap is really called goodwill. That's the calculated value that roughly corresponds to what's the value of having this team together? What's the value of the brand and name of the company? What are all the intangible things that they make this business worthwhile beyond the cash and the computers and the office equipment and the money people owe you? So you can see even in a large company, the goodwill can be a large fraction of the assets. It's not typically very liquid. In order to have any sense that you're going to be able to liquidate that, you pretty much have to sell the company. And in which case, somebody is buying that goodwill, hopefully. If you're in an asset sale where you're effectively going out of business and effectively the buyer is saying, I don't value the goodwill in this company. It's not doing anything for me. I'm not practically going to carry your brand forward. I'm not practically able to put a value on the fact that you're a team working together. I just care about your cash equivalents or your patents or your equipment that you own. And those can be very low value liquidations. And that partly reflects the fact that in those circumstances, your goodwill is not worth anything. And then you have liabilities. What do you owe to other people because you've been buying things? What do you have as accrued expenses where you actually are incurring liabilities because you're getting some sort of a subscription? Where did you take loans that you owe people and where that debt needs to be repaid, whatever the standard is, within a year? Where do you owe income taxes and so forth? And so you can get a current liabilities sort of picture here. And then you may have long-term liabilities. These are typically pretty small in a startup company because you probably don't have income taxes to pay. You may not have big leases. You probably have not taken a lot of debt because people don't loan a lot of money to startup companies because banks are different from venture capitalists. And then finally, you get a sense of, okay, if there is some net assets. And remember, net assets are sort of boosted by this artificial goodwill line. How does that play out? And how much do the stockholders actually own at this point? And it's nice and get to be a big public company. You can say, oh, there is in fact some equity that is owned by the shareholders. There are a set of things that you really want to keep track of. Understanding current liabilities is is critically important because you understand what is going to consume cash. Understanding the current ratio, that is, where's your cash or cash equivalents relative to what you need to pay out soon. And you would really like that ratio to be greater than one, because if it's less than one, it says that you are heading for a brick wall. Debt to equity ratio is not typically something that you worry about too much in a startup because it's hard to get a lot of debt. But in fact, there is venture debt that can come into it if you do find somebody who wants to loan to you. And then you have to think about what the debt as a fraction of the total assets or the accumulated equity that shareholders have. Burn rate may be the single most important thing. How fast are you going down the runway? Are you going to run out of runway? Are you going to get airborne? That is, start getting significant sales before you have depleted your cash. And finally, is deferred revenue a big part of what's going on, where you have nominally fulfilled you've booked the business, but you have not yet fulfilled the obligations. And some companies carry a great deal of deferred revenue. It can even be a good thing in the sense that you may get paid for a subscription up front, and all that has to happen is that time needs to pass, and you will have fulfilled the obligation because you have provided that ongoing subscription service. In some cases, it means that you still have deliverables, things that you promised. You said, in your contract, I'll deliver the current product and I'll deliver the upgrade that includes these critical features for you. You may not be able to recognize any of the revenue until you have delivered that upgraded version. Accounting principles are inherently pretty skeptical and conservative in the sense that they say that by default, if you have an obligation to deliver something, the product has no value in the hands of the customer until you've delivered it. So at the extreme, you get to recognize no revenue until you've fulfilled all the obligations. And so you have to, there'll be circumstances where that's not completely true, but think about the fact that it may in reality be that the product isn't genuinely useful until all of the little bits and pieces are there. If you promise training, the product may not be usable until you've done the training, etc. So thinking about metrics is important. And thinking, and part of what you're keeping track of with the metrics is the degree to which you are in compliance. You have certain kinds of obligations. One of the biggest obligations is you have employees. As soon as you have one employee, you have got an obligation to collect employment taxes and to, in many cases, collect tax stuff so that you are meeting your government obligations. It really makes sense to use a payroll service. Yes, you could do this by hand, and yes, QuickBooks will help you do this, but using a service for payroll at a minimum makes a lot of sense so that you're not writing a whole bunch of checks every 2 weeks. Insurance is an important thing, and I'm not even talking about employment insurance, but just things like liability insurance. Once you rent space, the landlord will typically require that you have some amount of liability insurance. If somebody falls and breaks their leg in your office space, you're liable, and the landlord will make it mandatory as a part of the lease that you carry that kind of insurance. You have tax compliance requirements. You have obligations to file. it's, I don't think, very onerous. I remember Martha working through a variety of different tax filings for federal and state and foreign. When it comes to foreign taxes, you probably want outside help to do that. You may have sales taxes, depending on what state you're operating in, that you have taxes collected from the end consumer if you're selling directly to the end consumer. Uh, and it gets more complicated across state lines. And then finally, you have payroll taxes that, you've got in the US, uh, FICA and Social Security things that you must collect, uh, as well as tax withholding. So you a lot of this is handled by the service. In fact, an important category of service provider is a service provider who is um, the nominal employer of your employees. They hire people for you for your exclusive use. They're not contractors, they really are employees, but they handle the insurance, they handle the payroll, they handle various aspects of compliance, and it takes a lot off your plate. And there are a number of good services for this, like TriNet, that really take a lot of the hassle off of you. And from a benefit standpoint, it's often very good because they have the scale to get better choice and better terms for health insurance than you probably could on your own. And so you can offer health insurance, dental, vision care that your employees might be used to at their big company. You can do things that are directly comparable, such that you're not saying, "Oh yeah, yeah, come to work for me and have lousy insurance." Um, Generally accepted accounting principles, GAAP, is the rather formalized system by which public companies are measured. But it's so ubiquitous that using GAAP accounting is quite important in some cases as you raise a significant amount of money and investors are looking to measure you with more or less the same kinds of yardsticks that they would use for a public company. It doesn't mean they're going to expect the same level of profitability. They typically are looking for a lot more growth and a lot less profitability than they would in a public company. But by standardizing the terminology and by assuring that what you mean by profit or revenue is the same as what is commonly assumed, makes it much easier to talk to investors. And probably the single most important thing there is revenue recognition. People want to believe they know what you're talking about when you say, "I booked this much revenue." And that commonality of language really eases the conversation. Investors are really uninterested in understanding your particular spin or take or alternative in revenue recognition. There are a set of principles in GAAP that I will mention because it gives you the spirit of what GAAP is about, rather than I expect you to memorize these rules and apply them constantly. But there are principles around which GAAP is created, which give you a sense of it. The principle of consistency, that is, that the same standards are used throughout the reporting process, that they're stable over time, and that it's consistently applied in every aspect of the business. That the accountant is striving to be as accurate as possible. That positives and negatives are fully reported with transparency, and that the people who are helping to construct that picture are not being compensated. That is, that the accountants have a neutral position, particularly if you're using a third party to put together your books. You don't want there to be a sense that the accountants are getting paid to make it look good. That there's a principle of continuity, that when you're valuing things like assets, there's an assumption that the business will continue to operate, which actually says that a lot of assets will be valued higher because they will continue to be useful. So you don't have to use the liquidation value of assets when you're doing asset accounting. That you've got the time right, that when you say that we're going to use this piece of equipment for a significant period of time, you figured out what's the appropriate time for that you may be depreciating that asset over the right 1 year, 3 year, 5 year period. And that you've allocated revenue appropriately. And that there is ultimately a principle of good faith, that you are assuming and requiring that everybody is remaining honest in all of this. And clearly, the wheels start to fall off if investors believe that you're not being honest in this. This isn't just a question that goes to the accounting team or the finance team. It ultimately comes directly back to the leadership, to the CEO, because he or she is the ultimate representative of the values and principles at work. And so if someone is being dishonest in the company, that's the CEO's problem.